Welcome to the summary of our latest asset allocation group meeting held on the 3rd of June 2026. All documents are available on mudzinich.com. Our key points for this month are: the US economy continues to deliver solid results supported by the AI cycle. Q1 Euro area GDP ex-Ireland proved surprisingly resilient, but there are weak signals ahead. Monetary policies cannot ignore higher for longer oil prices and the legitimate repricing of short rates. Credit spreads have stabilized at tight levels, but relative all-in yields suggest a rotation from euro to US dollar credit IG. The US economy continued to deliver solid economic data. While first quarter real GDP growth was revised down from 2% to 1.6%, domestic final sales were left growing a healthy 2.4% annualized. Business optimism remains strong, as demonstrated by May PMIs and ISM surveys, and new orders components suggest good momentum in the second quarter. CapEx related to AI remains a strong engine behind the growth numbers, offsetting contraction in ex-tech fixed investment. Private consumption has slowed to below 1%, but looking forward, higher tax refunds should offset part of the losses in purchasing power from the rise in gasoline prices. May employment report exceeded expectations, coming with revision from previous months. The 3 months moving average in non-farm payrolls is now at 188,000 per month, up from flat in February 2026. We do not see such an economic backdrop and relative improvement in employment as a justification for the Fed to raise rates just yet, and we believe the market is ahead of itself in expecting a policy rate hike before year-end. However, the next FOMC statement will likely remove the easing bias and quantify the inflation risk as a growing concern to monitor. Higher US market short rates are therefore justified in this context, even if the Fed does not deliver on these expectations. Eurozone real GDP fell by 0.2% in the first quarter, a clear contrast with the US. However, excluding Ireland, Euro GDP grew by almost 0.3% quarter on quarter. Nevertheless, signals from business surveys show obvious weakness in the services sectors and some risks ahead in the manufacturing sector once the front-loading impact of the Iran war dissipates by the end of the second quarter. With lower final demand on the horizon, corporates may not be able to pass through all the rises in input prices and may instead slow down production, waiting for some supply chain normalization. As we record this video, we don't know the outcome of the ECB meeting, but it is highly likely the policy rate is raised by 25 basis points. We would call this hike as a minimum insurance policy, aiming at confirming the ECB's reaction function and controlling the medium-term inflation expectations. We believe the ECB is equally concerned by the inflation risk and the negative impact on economic growth from elevated oil prices, and it will aim to avoid harming forward growth prospects unless a risk of de-anchoring inflation expectations is visible. We forecast the ECB could deliver another hike at its September meeting, but should be ready to reassess our scenario depending on news flow and new data. Moving on to our fundamentals, technicals, and valuations analysis framework. Fundamental scores were upgraded on average. A spectacular first quarter earnings season in the US, combined with a strong macro backdrop, leads us to upgrade the US scores. Emerging market corporate also delivered good results. We stabilize European fundamentals at neutral. The default rate is at new lows, and we remain reasonably confident in the fundamental corporate backdrop for now. Technical scores have also remained broadly unchanged, as the expected heavy supply in May has met a strong investor base. New issue premiums have moved slightly higher at the end of May, amid some supply indigestion in IG. However, secondary spreads are holding well, with spreads moving tighter. Credit market inflows have been relatively solid, with strong demand in the US IG markets and meaningful inflows into European high yield, attracted by the carry over expensive investment grade. In valuation terms, credit spreads have returned to tight levels, and there was little reason to improve our valuation scores. Given the quality of the fundamentals, there was also no incentive to downgrade the score either. We left the scores unchanged. In terms of portfolio positioning, we have little appetite for lengthening US duration on average, and we expect the spread between US and Euro yield to widen further. However, we notice institutional flows are coming into ultra-long-end credit, attracted by the level of absolute yield combined with the high credit quality of the issuers in this part of the IG curve. In parallel, we would invest in short-dated bonds to maintain portfolio duration in line with our objectives. We overweighted the euro and sterling credit risk in our global short duration portfolios in mid-March to take advantage of expectations of the repricing of short rates. New valuations on US rates are an opportunity to rebalance global portfolios to take advantage of US short rates repricing while taking some profit on euro sterling exposure. The premium between euro and US yields in short duration IG has now disappeared after hedging the currency risk. By adding US denominated credit, we find it interesting to add emerging market corporate exposure, which we were underweight from March to mid-May. Our EM exposure in global tactical portfolios has also increased. We also find value in floating rate instruments after the rally in bonds the final weeks of May. In a carry-focused strategy, all-in yields close to 8% in leveraged loans in US dollar are attractive, and we would add to this position. There was little sector rotation as dispersion has been low in IG markets and decompression limited in high-yield markets, with the exception of idiosyncratic stories in the US CCCs. So in summary, we are cautious in terms of duration after the mid-May rally. We take the opportunity of new valuation in US short rates to rebalance our past overweight in euro sterling to more neutral relative exposure, adding to dollar-denominated emerging market corporates. We keep an overweight in high-yielding assets, adding to floating rate leveraged loans in parallel with some ultra-long-end IG exposure. Thank you for watching. I look forward to speaking to you again next month.